Your insurance company just showed up at your office, not with a renewal quote, but with auditors. Sure, if you're a $500,000 or above operation, audits are a common sight. But here is the problem. From a resilience perspective, your underwriter's auditor may not actually know what they're looking for, and they certainly won't take into account your established programs in favour of cheaper premiums. Fixinc, the parent company of Unbreakable Ventures, has been watching this unfold across Australia and New Zealand in real time. Random audits are intensifying, auditors are appearing on site, and in several cases, they are getting it wrong or misinterpreting the policy decisions around core business continuity programs. Without a dedicated team, representative, or advisor, businesses risk being influenced into poor resilience processes in order to keep the auditor happy. Meanwhile, all eyes are on Iran, the US, and the Middle East. But this week, bombs started falling on data centers, not warehouses, not factories, cloud infrastructure. The same servers your suppliers, your payment systems, and your logistics partners might be running on right now. Coming up on Unbreakable Ventures, why insurance audits are catching businesses off guard, how to challenge findings that contradict best practice, and why a missile strike in the Middle East could take down systems you have never even heard of. Plus, in our quickfire segment, we look at tanker attacks in the Strait of Hormuz, with no end in sight. Why businesses are still betting big on Gulf markets despite the chaos. And a phishing campaign targeting Australian domain owners. It is Monday, the 23rd of March, and we are covering the world's global threats from the past fortnight. So grab a coffee and let's get into it. Welcome to Unbreakable Ventures. I am Ollie Law, Editor-in-Chief, and you are listening to our fortnightly risk update where we dive into emerging and current risks from around the world. We focus on some big stories and some you may have missed. We use the categories from the World Economic Forum's Global Risk Report to simplify the threats we are monitoring, but we also do some deep dives and interviews with industry peers. Let's start today's first main story with a question. When was the last time you stress tested your business continuity plan? Not read it, not filed it away, actually tested it. Because from what we've seen, someone else is about to test it for you and they might not be qualified to do so. Over the past 3 months, Fixinc has observed something concerning across their client base in Australia and New Zealand specifically. Insurance audits are getting more frequent, more intense, and increasingly, auditors are showing up in person on site, often unannounced or with little warning. Now, this level of scrutiny used to be reserved for the big players, the multi-million, even billion-dollar annual revenue end of town, but not anymore. Smaller organizations are now facing the same level of examination. The auditors and underwriters are looking at business continuity plans, business impact analysis, emergency management procedures, and cyber resilience documentation. They want to see evidence, real evidence, that you can survive disruption. But it's getting more complicated than that. Fixinc has found that in several cases, the auditors themselves are not adequately trained in business continuity frameworks. Fixinc's advisory team has had to guide auditors through best practice systems and spend time explaining processes. Think about that for a moment. The people checking your programs do not always understand the work, and that creates real risks for your business. Incorrect advice could push you to change policies that were already correct. Progress on existing resilience programs might get delayed or worse, derailed entirely. And if flawed assessments make it into the final report, your premiums could increase based on inaccurate findings. Now let us talk about the broader context. The 2026 Allianz Risk Barometer confirms cyber incidents remain the #1 global business risk for the 5th consecutive year. Business interruption sits at number 3, and only 3% of respondents view their supply chains as very resilient. In Australia specifically, insurers are now refusing coverage or hiking premiums for businesses that cannot prove baseline security standards. The Australian Cyber Security Centre's Essential 8 has become the benchmark. If you cannot demonstrate compliance, you are a higher risk and you will pay for it. So who should be paying attention to this? We're finding that some industries are being targeted harsher than others. Universities and higher education institutions, for example. Fixinc has directly observed intensified audit activity in this sector. Auditors are examining emergency management procedures and business impact analyses in granular detail. Ports, logistics, and supply chain operators are also being hit hard as pressure on global freight routes are critically disrupted. The World Economic Forum identifies geoeconomic confrontation and supply chain vulnerability as top-tier risks for 2026. Insurers are closely examining business continuity documentation for critical infrastructure and alignment to findings like this. Financial services and healthcare are another one. Industries with stringent data protection regulations face dual pressure from compliance audits and insurance underwriting scrutiny. And mid-market businesses who assume they are exempt are now on the radar. Documentation requirements are extending down the chain. Sure, auditors aren't expecting the level of resilience compliance you'd expect at a multinational, but they are looking for deeper evidence on policy and validation. We've investigated instances where the insured confirms annual training of cyber processes, with the underwriters then asking for evidence. Meeting minutes, workshop attendees, even sight of the calendar invite to the team. So what can you do about this? First, prepare evidence before the audit arrives. Do the hard work today. Review and document your business continuity plans now. Ensure documentation is current, tested, and evidence-based, clear version control. Records of your most recent exercises. Second, understand what auditors are actually assessing. Map the typical areas like risk management frameworks, incident response plans, backup and recovery procedures, supply chain resilience and governance documentation. If you cannot demonstrate these are operational, not just documented, you have a problem. Third, and this is important, challenge findings that contradict best practice. At each premium renewal, you are in negotiation. You very much have the influence to question and challenge presumptions of your resilience. If an auditor gives you feedback that does not align with established business continuity frameworks, question it. Ask them to show their methodology and compare. You've worked hard on your programs. You are investing substantial resource and budgets into these. Use them to reduce premium pressure. Fourth, request real-time feedback throughout the process. Do not wait until the audit is complete. Ask auditors what they are finding as they review your documentation. Address concerns immediately and avoid surprises that could impact premium negotiations. Fifth, plan for the resource drain. Audits consume significant internal capacity, and your team is already managing daily responsibilities. Factor this in. Consider whether external advisory support is needed to avoid derailing operations. After all, most audits don't happen on the week of your renewal. In fact, 3 out of 5 audits we've observed happened around the midway mark of a term. And finally, demand transparency on the resilience to premium linkage. Not enough organizations do this. Strong resilience should directly improve your premium position if you are at less risk of activating the claims process. If your renewal reflects increased premiums despite robust documentation, ask why. The connection between your investment in resilience and your insurance outcomes should be explicit and auditable. Fixinc will be publishing a detailed guide on preparing for and managing insurance audits soon. It will have a focus on the practical steps on how to manage an audit, but also how to reduce premiums through evidence-based resilience programs. Keep an eye on that resource via fixinc.io.
You are listening to Unbreakable Ventures, a threat intelligence publication by Fixinc. Subscribe today via unbreakableventures.com to receive free resource and deep dives from industry experts. Unbreakableventures.com, where resilience is about community and communication. Subscribe today.
Before we move on to our second threat update this week, we are sharing our quick-fire emerging threats we have picked up throughout the fortnight. These will be noteworthy stories we think you should know about, but less detailed than our two core threats analysed. The Strait of Hormuz shipping crisis shows no signs of resolution. Tanker attacks continue to compound global shipping disruptions. Iran maintains mobile oil infrastructure positions, and the conflict with the United States extends into its fourth week. The critical risk for businesses is the absence of any diplomatic pathway to resolution. Each passing week doubles the compounding economic impacts. Sustained high oil prices, shipping delays, insurance premium spikes, supply chain bottlenecks rippling far beyond the energy sector. Despite the volatility of the Strait of Hormuz, global businesses are maintaining their Gulf investment commitments. Multinational companies continue expressing strong confidence in Gulf markets for long-term expansion. The apparent contradiction reflects recognition that Middle East economies offer significant growth opportunities that outlast current instability. Businesses are differentiating between short-term operational challenges and fundamental market potential, building enhanced contingency planning into their regional strategies. Mailguard has identified a phishing campaign impersonating Vodafone. Fraudulent domain expiry notices are being sent to harvest payment card details from Australian businesses. The risk extends beyond credential theft. If victims provide login credentials, attackers can hijack domains, redirect business web traffic, intercept emails, and conduct further fraud using legitimate company domains as cover. Morgan Stanley warns that ongoing oil supply disruptions will cascade across key Asian sectors: manufacturing, transportation, and chemicals production. Knock-on effects will extend to consumer goods pricing and export competitiveness. Businesses dependent on Asian manufacturing should anticipate production delays, cost increases, and potential component shortages over coming months. China has urged an immediate halt to military operations in the Middle East, warning that regional escalation threatens global economic stability. The intervention signals Beijing's concern that conflict-driven oil price spikes and shipping route closures could undermine Chinese economic recovery objectives, while simultaneously positioning China as a potential diplomatic intermediary seeking to preserve trade route access. Further sources and references can be found in the footnotes of this podcast. But without further ado, let us look at our second threat update this fortnight. With everything going on with the Iran conflict, many business leaders are trying to identify what are the right questions to be asking right now. A new one to add to your list you may not have thought about is whether a missile strike in the Middle East could take down your payment system. Could it take down your logistics platform, your customer database, just about anything else that runs your business? The honest answer for many organizations is that yes, it could. Over recent weeks, military strikes on data centers during the ongoing Middle East conflict have created unprecedented questions, legal questions, policy questions, and very practical operational questions for businesses worldwide. Amazon's web services, Google Cloud, Microsoft Azure, these are facilities in the region that now face potential targeting as dual-use infrastructure. International humanitarian law traditionally protected civilian infrastructure, but the increasing military and intelligence reliance on commercial cloud services has blurred those distinctions. Some legal scholars argue that data centers processing military communications may lose protected status under the law of armed conflict. But those same data centers are likely powering medical information, private business, and supply chain. Even if you think you are far removed from the Middle East, this problem still matters at a more complex level than you may realize. The concentration of global business operations on a small number of cloud providers means a successful strike on major data centers would cascade disruptions far beyond direct customers. Think about your own business for a moment. You might use Amazon Web Services directly, or you might not. But does your payment processor, does your logistics partner, CRM vendor, accounting software, A data center strike affecting services you do not directly use can still cascade through your supply chain, disrupting operations through fourth and fifth party dependencies you may not have even mapped. Amazon operates data centers across multiple global regions, specifically to provide redundancy. That much is true. But threat actors increasingly view major cloud providers as strategic targets, because disrupting one provider can simultaneously impact government systems, financial services, healthcare, critical infrastructure all at once, or worldwide. So ask yourself, is the conflict in the Middle East risking my infrastructure somewhere else in the world? If you cannot answer that question with confidence, I'm afraid you have work to do this week. Let's explore who should be most concerned about this. Cloud-dependent businesses without geographic redundancy, organizations relying on single region cloud deployments face acute risk. Even well-established providers cannot guarantee availability if facilities become military targets. You must understand your actual infrastructure footprint, not just assume provider resilience. Companies with complex third-party supply chains, your direct cloud provider may be resilient, but your payment processor might not be. Your logistics partner might not be. A strike affecting services you do not directly use can still take you down. Financial services and critical infrastructure operators, these sectors face heightened regulatory scrutiny around operational resilience. So you must demonstrate you have identified and mitigated concentration risks. Regulators increasingly expect documented evidence of third-party infrastructure resilience testing. And businesses with Middle East regional exposure, whether operations, customers, or suppliers in the Gulf region, you face direct exposure. But geography is not insulation. Global businesses must consider whether Middle East data centers host any services in their extended supply chain. With all that in mind, what can you do? First, map your complete infrastructure dependency chain, not just your direct cloud providers. The infrastructure dependencies of your critical third-party services, payment processors, logistics platforms, communication tools, SaaS applications. Understand which data center regions these services use. Identify concentration risks that could create correlated failures. Second, test for unlikely but possible scenarios. Conduct tabletop exercises specifically modeling scenarios where major cloud infrastructure goes offline. Due to conflict, cyber attack, physical damage, many businesses have never tested for simultaneous loss of multiple cloud services. That scenario is now plausible. Third, demand transparency from your providers. Request documentation about geographic distribution, redundancy architecture, continuity plans for regional infrastructure loss. Evaluate whether contractual SL as address conflict-related disruptions or contain force majeure exclusions that would leave you exposed. Fourth, where feasible, implement geographic and provider diversification architect systems to operate across multiple cloud providers and regions. This increases complexity and cost. But concentration on single providers creates systemic risk. For critical business functions, that risk may be unacceptable. And finally, establish offline fallback procedures. Identify which business processes could continue with degraded or offline cloud services. Document manual or alternative procedures. For functions that cannot operate without cloud infrastructure, ensure leadership understands the recovery time implications. We are talking days or weeks, not hours. The legal and policy debates will continue, but the operational reality is clear. Third-party infrastructure you have never thought about could be your single point of failure. And the conflict deciding whether it stays online is happening right now. The question you have to ask yourself is whether you can be confident in your understanding of the web of threats this conflict presents, or whether you are reacting to the daily news cycles. The former takes time and energy, but it results in a higher level of resilience, while the latter will hold you to the mercy of greater powers.
That's it for today's update. If you need help navigating these threats or building a plan to protect your business, the same advisors who collate these insights are here to help. head over to unbreakableventures.com to book a complimentary chat online with one of them. And if you found this resource useful, consider subscribing to Unbreakable Ventures or sharing the article with your network. After all, resilience is about community and communication. Until next time, stay curious, stay informed, stay safe.
Unbreakable Ventures is brought to you by the Senior Advisory Team at Fixinc, a boutique resilience advisory based in the Oceania, ASEAN and India regions. Special thanks to our sponsor and Europe's leading SaaS provider for resilience software, F24. Our resources are researched and published by industry specialists across New Zealand, Australia, Malaysia and the UK. This podcast provides advice and opinion on disaster recovery and the threat landscape. The content is not a substitute for expert guidance during a crisis. Unbreakable Ventures is trademarked by Fixinc Consulting Partners, a Fixinc Group company.